Really?
Yeah. Well, maybe I know the pattern once I see the pattern, but from the name, no, I haven't heard of this.
Huh.
Jordan V for forks. That's what it says. Hey,
Yeah.
I like bacon.
So,
I'm not gonna lie. I do like meat.
of course, Sasquatch would say something like that. Beautiful name. Sorry about that. Charles is also a big fan of bacon, my beautiful golden doodle. So typically a desk cross pattern appears where short-term moving average crosses a long-term moving average. It's an indication of weakness in a particular asset, whether that be an indice. It's the opposite of a golden shower. Not exactly.
Yeah,
not exactly.
I have a different interpretation of what a golden shower is because
a golden cross. A golden cross is what he's talking about.
Yeah, golden cross. I was going to say golden shower. Like, I think we're on different wavelengths on what that means.
Yeah.
Okay, I'm glad we're on the same page.
Yeah, he meant a golden cross. Kaizen is 100% right. This is a pattern that's really used a lot in very volatile assets on shorter time frames. It means it's an opportunity to short when the short-term moving average crosses the long-term moving average. When you're talking about big economic data, like when you're talking about the Wall Street Journal talking about it, and Yahoo Finance, they're not looking at the short time frame. They're looking at the dailies, weeklies, monthlies, and they're usually talking about a 50-day moving average crossing the 200-day moving average. Okay. So when we're talking about this stuff, it's I'm talking about it on a bigger kind of time frame, time scale, but this can also apply to long and short term investing. When you're looking at this stuff, there's a bunch of different data on when this chart pattern came to be. There's a bunch of different data on when every chart pattern came to be. Several different people claim ownership of it. It probably in some way, shape, or form was affected by this book that came out in 1948, a book on technical analysis of stock trends. This is the second book of its kind and the most influential book on technical analysis. It's been around for forever. It's actually on its 10th edition now. So if you're interested in getting into the origins of this stuff, this is where I would try to find it. Just a quick review, moving averages, or take a look at a given period in time. So a 50-day looks at 50 days, a 200-day looks at 200 days, and takes the average closes of those days, and it creates a short pattern, a line showing where, on average, a particular asset has been closing. Here's a good example, just looking at 15 days. Obviously you have 5 trading days within a given week outside of next week here in the States when we have something like Thanksgiving. But for the most part, it's 5 trading days in a week. So a 15-day moving average would be looking at 3 weeks of data. 50 days would be looking at 10 weeks of data, so on and so forth. Just a quick review of that. Also, there are simple moving averages, exponential moving averages. That's kind of out of our scope for this conversation. But most of the time, people are looking at SMAs when they're talking about this kind of thing. This is what the actual pattern looks like. And this is actually taken away from the site that I got this information from. Sorry, there's a little bit of data on RSI there. This is my first draft of this one. I thought I uploaded the second one, but that's okay. So the Dow Jones moving average, this is what we're looking at. You're seeing the blue line, the 50-day moving average, crossing the gold line, which is the 200-day moving average. This is the first time it's happened since March of 22. And as you can see, back in March, when this cross happened, we saw quite a dump in the Dow Jones, and we saw quite a dump in the other indices as well. Now, obviously, this is just an asset. This is just an asset indicator. This is not a for sure thing. This is not something that we can depend on solely for our analysis. When we're talking about these big economical moves, we need to understand that there needs to be a lot of fundamental support for Duff crosses to work on a large scale. Inflation just came in at 0.0 last month. I don't think the Dow Jones is going to take that data poorly. They're probably going to run off of that, as will the NASDAQ, as will the Russell, as will most assets here in the States that are affected by that inflation. When you're day trading with this kind of thing, on the other hand, just like Kaizen was saying, using this pattern in crypto is super common. Using it in penny stocks is super common. Using it in the NASDAQ is super common, even where I trade. But it's an indicator at the end of the day. It has to be used in conjunction with other things. And when you're talking about using this death cross in markets that are strongly trending, like the Dow Jones right now, Dow Jones has been on like 12 up days in a row, just like the S&P, just like a couple other assets. It can leave you in a dangerous spot. And so I always encourage people looking at this pattern or any pattern like it to be incredibly cautious when you're jumping into these types of positions. If the 50-day moving average crosses the 200, you don't enter a position right there. You have to kind of wait for things to play out. This is one of those indicators that lets you know that something could happen in the near future, not that something's happening right now. So leading indicator, not a lagging indicator. That's the death cross with the trading lab.
Beautiful. Beautiful. Yeah.